This is Matthew Cratter from Trader University, and today I want to talk about Social Security cuts and how they could lead to a stock market crash. If you're interested in learning how the economy actually works, so you can make money in both bull and bear markets, be sure to hit that subscribe button. So in general, as you guys know, if you've been watching my channel, I'm quite bullish on stocks, on gold, and on Bitcoin over the coming years. But I think there's a possible scenario that could really mess things up, at least over a short period of time. And that is possible cuts to Social Security. So there's been news in the last couple days. The CBO, the Congressional Budget Office, came out with an updated budget outlook in which they incorporated more of the ongoing effects of the pandemic, as well as sort of updating how the Social Security trust fund looks and when it could be depleted. And they're now saying that it's going to be depleted much earlier than expected, probably 2031, so in about 11 years from now. And as a result, there have been a bunch of stories, this one's from Fox, about Social Security benefit cuts coming. Now, I don't think this is something that could happen. I don't see in the current environment how it's politically feasible. But I wanted to walk through this scenario because I think it's kind of interesting and counterintuitive. Obviously, benefit cuts would be very bad for people retiring. Here I'm looking less at the individual level, but looking at the level of the economy as a whole, because I think it's a little bit counterintuitive. So if the U.S. were to cut back on entitlement spending, this is not something that I see Trump doing, and it's not something that I would see either a Joe Biden or a Kamala Harris doing as well. But let's say this happened for various reasons, and there were these sort of permanent cuts incorporated into Social Security and Medicare, which are the two big entitlement spending programs. What would happen is the federal budget deficit would shrink very sharply. Right now, government spending is about 6.2 trillion for this year. This is the kind of a running total. And we can see if we add up Medicare, Medicaid spending, and Social Security spending, their total comes to about 39% of the total spending. So it's a huge percentage of the government budget deficit. And it's also projected to rise, obviously, as more baby boomers enter their retirement years. And so we have these very large budget deficits, which just means that the government's spending more money than it's bringing in taxes. And that shortfall is being made up by selling U.S. government debt, U.S. government bonds called Treasuries. And the buyer of last resort for these is the Federal Reserve. The central bank is printing up new money and buying these treasuries to basically monetize the debt. I've talked about this in a lot of previous videos if you guys want to check those out. And so what this would mean is if there were a big cutback in entitlement spending, the budget deficits would be a lot smaller. The Treasury, U.S. Treasury, would not need to issue as much government debt, and the Fed would need to print a lot less money. And so if the U.S. were to cut back on entitlement spending, much more than Europe, let's say Europe kept things constant and the U.S. cut back, you would have the situation where the Fed would be printing a lot less money than the ECB, the European Central Bank, would be printing euros. And in general, I am a U.S. dollar bear against other fiat currencies. But if this were to happen, what it would mean is you would get a very large U.S. dollar rally certainly versus the euro and the eurozone. If we look at the U.S. dollar index, it's primarily, huge percentage of it, 58%, is euro, with lesser weightings toward the yen, pound sterling, Canadian dollar, etc. But it's mostly a euro currency basket against the dollar. And so if you have the U.S. dollar rallying sharply against the euro, it would basically mean that you get a big spike in the DXY, the DXY, which is the dollar index. And as we know from March, this is when we had the last big spike, when the pandemic really hit or was realized in March of 2020. Dollar strength or DXY strength is associated with a big sell-off in risk assets. And so when the dollar strengthens, especially if it strengthens violently as it did like this, you get gold selling off, you get Bitcoin selling off, you get stocks selling off, and you enter kind of a risk-off scenario. And so what could happen in this environment is, paradoxically, even though it would be an example of the federal government getting a little more budget discipline, you would have an environment where the U.S. dollar strengthened massively. And I think we would get above these March highs. So we get a massive period of U.S. dollar strength, which is generally pretty bad for the stock market in general. And so we would see almost certainly stocks head down quite severely. And a lot of this has to do with the Eurodollar market. There are these offshore dollars, this whole funding market. And whenever the dollar strengthens, it causes problems in the Eurodollar market. And so you get this kind of risk-off environment. I talk a bit more about that in detail if you just Google Treasury University and Eurodollar. So basically, stronger US dollar caused by Social Security cuts could lead to a stock market crash, probably bad for gold and Bitcoin as well. Not necessarily bad if you see Bitcoin adoption go up a lot. It could help to counteract these effects. And the important thing to remember is that the US dollar and the euro are sinking ships, by which I mean they're assets that lose value over time. Every year, fiat currencies like the US dollar and the euro lose a little bit of their purchasing value. They lose a little bit of the value. And that's why I call them sinking ships. And so the exchange rate between them is basically a question of which ship has taken on or is taking on more water. Gold and Bitcoin are much more permanent stores of value. It's a little bit more controversial to say that about Bitcoin. I believe it is, but certainly gold is as well. So you could have an environment where the stocks go down and the US dollar strengthens and maybe gold and Bitcoin hold their own. But it would definitely be a strong headwind for both of them. And so I think this is a scenario that's extremely unlikely. I don't see how politically feasible it would be to cut back on benefits to people who have been paying in their whole lives. But this is a scenario that would definitely cause me to change my view of the US dollar as being bearish on the US dollar versus other fiat currencies like the euro. Let me know if you have any questions about this. If you want to do a deeper dive into entitlement spending, Social Security, and Medicare, I'll link to this video below. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell so you'll be notified when I come out with my next video. And let me know your questions and comments. Thanks a lot for watching, and I'll see you in the next video.